Welcome to another edition of Market Pulse Weekly, your trusted guide to actionable financial intelligence. With years of market experience, we are committed to helping new and struggling traders and investors build a clear, disciplined path to profitability. Our mission is simple: eliminate guessing and gambling from your trading. Instead, approach the market with strategy, structure, and confidence. Today, we will be discussing different fundamental data that acted as a catalyst and moved price in different directions in previous week, and what data will impact price the most in the market this week. But before we dive into today's lesson, here is a quick disclaimer for our listeners. The information provided in this material by Renaissance Capital is intended solely for educational and informational purposes. It does not constitute financial advice, investment recommendations, or an offer to trade any financial instrument. Trading in forex, CFDs, and other leverage products involves a high degree of risk. You may lose part or all of your capital, and you should never trade with money you cannot afford to lose. While every effort has been made to ensure the accuracy of the information contained herein, Renaissance Capital assumes no responsibility or liability for any financial losses or damages resulting from the use or misuse of this material. Readers are strongly encouraged to seek independent financial or professional advice before engaging in trading or investment activities. In previous video, I discussed how we approach the market at Renaissance Capital, but I would like to reiterate that we are heavily vested in fundamental data in our trading methodology. Fundamental data has helped us over the years to be able to be, accountable to how price move. It gives us reasons for why price behave the way they behave, rather than relying solely on technical analysis and the likes. So we usually begin with our methodology from fundamental analysis. We look for what is currently responsible for the way the market is behaving from a fundamental level. Then we look out to see how the large-scale investors are investing. Generally, we just, look at the current mood of the market. Are large-scale investors willing to take risk, or are they scaling back on risking earlier? Is there fear in the market? Then we move down to our technical analysis. Mostly we do a technical analysis that is combined with trading along with the weekly range. Top-down analysis starts from the quarterly time frame, the monthly time frame, the weekly time frame, the daily time frame, and sometimes 4 hour. On the 15-minute time frame, we open our trading position. We look for a best place to buy, and time and price plays a lot of factor when it comes to trading. So we utilize the sessions, the timings, and whatever data comes into the market at that particular time. Everything is is integrated into one. Based on our research, that is the most profitable way we have been approaching the market over the years. In previous week, we had a couple of data that came into the market that I would like to discuss about, that were responsible for the way price moved. One of these data at the opening of the week is the US ISM Manufacturing Index data that came below market expectation. Although we noticed that it didn't seem to influence the strength or the weakness of the US dollar, which currently was being weakened across board by an increase in the order of interest rate cuts. We also had statements from the Japanese economy. According to the BOJ governor, E02, he mentioned that an interest rate might likely come faster than the market is anticipating. This statement buoyed the Japanese yen against major currencies in the market. We also had the Japanese November consumer confidence that beats market expectation. Based off a handful of good data from the Japanese economy, the JPY continued to enjoy a tailwind against other currencies for the most part of the first half of the previous week. We also heard from the Japanese Minister of Finance. He had highlighted that the BOJ will be setting monetary policy. The minister didn't need to announce the primary objective of the Bank of Japan. However, the market saw it as a form of pushback against an intervention charter. We also got data from the Australian economy. The third quarter GDP data came below market expectation. However, the data was faded. The AUD only weakened for a short time because the GDP data didn't really influence the RBA's interest rate decision at the moment, as the RBA is more focused on economic data such as the inflation and employment data. We also got data from the Switzerland economy. The Switzerland CPI also recorded a lower than expected CPI. We also got data from the US economy. Weekly ADP employment data came in below expectations. The recent ADP data has been reflecting broader weakness in the labor markets in the US. This is the reason we have been seeing a form of headwind in the dollar recently. Due to comments from stakeholders in the Japanese economy and the data we have seen this week so far, or the data we have seen in previous weeks so far, the probability of a rate hike in December is high, although it contradicts the new Prime Minister's fiscal plan. But we will be monitoring closely if the hike will eventually be delivered. Much of this has been alluded to by the BOJ Governor Yoder early in the week. The US also released their unemployment claim for the month of September. A lower than expected unemployment claims was delivered, and this helped to underpin the dollar from continuous weakness in the middle of the week. Prior to the release, we had seen a broadened weakness coming to the dollar due to a high chance of a rate cut. This data sort of gave dollar a form of respite. Close to the week, dollar was able to move from the low formed midweek. We also noticed that Morgan Stanley joined the other market participants in anticipating a Federal Reserve rate cut in December. Current market pricing reflects an 86% probability of a 25 basis point reduction at the upcoming meeting. Currently this week, despite the data docket was empty on Monday, markets seemed cautious. Dollar benefited as safe haven assets thrived. Japan was struck by a magnitude 7.6 earthquake. In view of this development in Japan, I don't see the BOJ hiking rates in December, in my opinion. We also got data from the Reserve Bank of Australia where interest rate was kept unchanged. In Governor Bullock's word, he said that the board envisions staying in a long pause or hiking, and that cuts aren't on the books for the RBA. We also noticed that despite incoming BOJ rate hike and constant jumboning from the Minister of Finance and the BOJ governor, the Japanese yen continued to experience a free fall. In the US, the ADP 4-week average employment data beats market expectation. This is the first positive catalyst for US dollar this week. Overall, the Fed are still priced for a cut this December. This is a better figure compared to September figure. Despite this, the US job market seems more complicated, as it seems employers may be, posting jobs, but overall they are not aggressively hiring, especially in this holiday season, and workers are not accepting new rules. That signals an increasingly cautious market. The FOMC meeting is the most important data this week. The Fed delivered the 25 basis point interest rate cut for December as anticipated. There were 4 things we were looking out for in the FOMC release. Number 1 is that we monitored the manner in which the Fed president voted. We also noticed the dot plot. Before the rate decision, 2 rate cuts was priced in for 2026. We also paid close attention to Fed Chair Powell's guidance for incoming months on rate decision during the press conference. Lastly, we also looked at the summary of economic projection. We're looking to see if the Fed will raise or lower the GDP, the employment and unemployment, or inflation forecast. This will help determine where the economy is moving in 2026. We noticed that a hawkish cut was delivered during FOMC release at 8 p.m. here, but it seems that the markets fade the hawkish cut that was delivered. However, what gave way for the dovishness in the market was when Fed Chair Powell delivered a dovish comment during the press conference. He sort of downplayed the inflation risk and put more emphasis on the labor market. And we know the current weakness in the labor market, and we have been hearing time and time again that the Feds are focused on the employment side of the economy. That is, Fed is prioritizing jobs right now and not inflation. Because earlier in the week, we had gotten information that tariff-imposed inflation would eventually fade away. We got data also from the Swiss economy. They Swiss National Bank kept interest rate unchanged. The Swiss economic outlook was upgraded due to the recent decrease in its exposure to US tariffs. The chair of SNB, Swiss National Bank, also downplayed the disappointing inflation readings in recent months and reiterated that the bank expects inflation to pick up slowly in the coming months. Today, also in the market, the US jobless claim was released, and we got a higher than expected jobless claim, and this further weakened the US across board against major currencies. The last important catalyst in the market this week is the UK GDP. The market is expecting a better GDP figure this time compared to previous months. Monday we had the empty data docket. There was no fundamental catalyst in the market, although the market seemed cautious. We also had the RBA delivered a interest rate cut. Governor, the BOJ governor also spoke early hours of Tuesday. We also had the ADP weekly employment change the same day. Job opening was released. On Wednesday, we had the unemployment cost index. We had the BOC statements on Wednesday that came in line with expectation. The Bank of Canada held rates. We had the federal fund rates drop by 25%, 0.25%. We had the FOMC predictions on Wednesday. Today we had the employment change for the Australian economy. We also had the Swiss National Bank delivered pause in interest rates, like we had SMB policy rates. We had the unemployment claims that came higher than expected, which made the US dollar weak. So the only important data left in the market for this week is the UK GDP data that will be released at 8 a.m. tomorrow morning. As usual, these are the currency pairs that will be trading in the market for the rest of the year for a long time. Basically, for those that were interested in buying, will be buying the pairs on the left hand side and will be selling the pairs on the right hand side. So that's how we are positioned for these pairs. USD JPY, we are only looking to buy USD CAD. We are only looking to buy the GPY. We are only interested in buying CAD JPY. With the JPY, we are only interested in buying Euro CAD for selling. The pairs we are interested in selling, Good with £10 CHF will be sold. We are only looking for a sell trade here. Also for Australian dollar, Canadian dollar, we are only interested in selling this pair right here. However, we just don't go blindly into the market to start selling and buying. We are closely monitoring fundamental data on both pairs as it affects one. For instance, this week, notice that the likelihood of beginning from 2 weeks ago, after the New York Fed Williams had endorsed that a cut was imminent in December, we are seeing a lot of weakness coming to dollar. So we note that down. For the Great Britain pounds, we are seeing a form of resurgence or a increase in the probability for a rate hike in the month of December. That is the data we're expecting. One of the important data coming to the market next week. So this has validated it has invalidated our position for a short time until we begin to see positive data coming to dollar. That's when we might consider buying this pair. Do you get me? That is it basically. Let's quickly dive into our charts to see how the dollar is behaving. Normally we start technical analysis on the quarterly time frame. I had clearly stated in the first video series. You can see market is within this range and this range. However, the most consistent character we can see here is that the US dollar had been bullish from the low formed 1st of April 2008. We had seen series of higher and higher lows. So currently, after market had moved to this high, it's moved sideways, and we have had weakness coming to dollar from January to June basically. And from that point, we had been, moving sideways. Dollar has been moving sideways, basically. We are hopefully see in the near future if it will continue to the upside or sideways or to the downside to take out the low sitting here. Let's move to the monthly time frame. In the monthly time frame, you can see that the dollar had been consolidating within this range for some time now, for months. So depending on the type of data that comes into the markets concerning the US economy, that's what will really dictate where the price is going next for the US dollar. However, we want to note that price has already taken out the low here. There are sell side imbalance here. Those are area of interest we will be looking out for. Pool of liquidity sitting down here also. Let's quickly dial into the weekly time frame to get a closer look at what is going on here. Price is within this high. This high is 101.90 and this low at 96.40. We have been sideways since this low. Although price came to take out the liquidity sitting below here, it rallied. This is I think this data came in at the last FOMC meeting when we had a hawkish pause. So far, we have had about 3 interest rate cuts was delivered today in the US economy. So we are seeing, from this FOMC hawkish pause to when New York Fed Williams had endorsed a rate cut for US dollar, we are seeing price rally downward, and dollar has not really had enough room to counterbalance this trend. Despite that, it has had a few good data and bad data. So we are currently here. We have one more day to go. We have one more trading day to go this week. On daily time frame, you can see on Monday and Tuesday we had some form of bullishness coming to dollar, but after the FOMC meeting, after the dovish comments from the Fed chair during the press conference, we are seeing weakness returning to the dollar. Whatever happens tomorrow, I'm still interested in. I think I'm just biased. I'm more interested in, we are more interested in seeing dollar strength, but nevertheless, data dictates all. For the US JPY, we can see that on the quarterly time frame, we had the first half of the year where the JPY was weak. I mean, the dollar was weak. Second half of the year, now we are seeing some form of trends coming to dollar. So we are still bullish long time here. On the monthly time frame, we are actually still bullish here. We are thinking of taking a buy for US dollar against the JPY. We are selling the JPY and buying the dollar. This is the current highest high at 160, let's say 162, and the closest low here is 140. So price had been range bound within this. We can also use this and this, but the most constant character here is that dollar has been been stronger than the JPY. That's why you're seeing some form of bullishness here. Let's scale down to the daily time frame. You can see a series of higher highs, lower low. We are basically bullish here, although we experience some form of consolidation here, and price ran through it, returned to this flip zone. That's an old resistance that became a support, and price continued. So we are targeting this 157.90 thereabouts, 158 thereabouts. So we are bullish, still bullish on USD JPY. Another pair we're interested in is the USD card. On the start from quarterly time frame, price has been in some form of consolidation that ran this for some time. Price had not broken above this high until first quarter of this year, and price ran here, and we are buying. We are buying this pair. We are not thinking of taking the other side of the trade, but nevertheless, whatever decision we take will be heavily data dependent. On the monthly time frame, it's obviously a form of consolidation, but because this had been broken, we are looking for a retracement. We are at a discount level here, and we are expecting that price will rally and break this new high that was created. However, due to negative data, due to the fact that US dollar had been at the receiving end of negative data, that's why we have seen some form of weakness coming to the dollar. On the weekly time frame, we are seeing some form of weakness coming into this to the US dollar card. The likely targets is the low sitting here before we see a continuation. On the daily time frame, likewise, we are seeing some form of head and shoulder pattern, which is a common reversal pattern in the market. So perhaps market targets this before it runs higher or it comes here. So every trade decision is will depend on data. You can see if we go back to the weekly time frame, we will notice that after a spew of negative data from the Fed, that's when we began to see CAD do better than the dollar. So far this week we have had this is Monday, this is Tuesday, this is Wednesday and Thursday. The next pair we're interested in trading is the AUD Price is range bound. As you can see, this high formed 1st of October 2007 was broken at second half of 2024. Price came here, and we know that the Japanese economy has been in deflation for quite some time. So far, this is January. This is the first quarter, the second quarter, the third quarter, and the fourth quarter. We have basically been in a bullish trend. So we are only interested in buying AUG, the Australian dollar, and selling the Japanese yen. For this pair, we can see a case of a clear bullishness here. On the weekly time frame, we can see that we are also bullish. Likewise, on the daily time frame, we are bullish. So far this week, Canadian dollar, Japanese yen is basically range bound, is sideways. This is the highest high, this is the lowest low, and price took out the liquidity sitting here and has rallied since. That's 1st of April, second quarter of 2020, and price had run all the way. So we're only interested in buying Canadian dollar and selling JPY. On the monthly time frame, we can see bullish. Weekly time frame, range bound, basically prices within this high and this low. The low here was taken out here, and we are basically buying this guy. Here's the JPY. Next, for the last pair we are interested in buying, let's move to the quarterly time frame quickly. Price is sideways for the euro card, basically sideways, but since this low was taken out second quarter of 2022, price has been rallying ever since. Let's scale down to the monthly time frame. We are basically still, although price is at a overbought zone right now after taking out this high, perhaps we'll see a retracement to feel we have a fair value gap that might be interested, that markets might feel before a continuation to the upside. But overall, we are still looking for a buy. Market is sideways. You can see down here that liquidity is the liquidity in this pair is very, very low. So you should not be surprised when you see some form of consolidation in Eurocard. The only thing that can push it to the either extreme is fundamental data. Please, guys, take fundamentals. It's very, very serious. It usually makes trading very easy and hassle-free. Let's scale down to the daily time frame. We can see we had clear bullishness come here. Markets broke this price and had struggled to come above this level, but we have seen some form of bearishness come into this pair. So peradventure that we get a weak data from the Canadian economy, and the Euro economy gives us a good data, whether from the employment side or the inflation side, then it will give us more leverage to act as planned, to help us execute our trading plan flawlessly. Now, for the pairs that I'm interested in selling in the market, I will start with the Great Britain pounds and the Swiss franc. Let's start our analysis from the quarterly time frame. This pair is predominantly bearish as far back as second half of 2007. Price had rallied. Price had been bearish all the way. So we are only looking to sell the Great Britain pounds and buy the Swiss franc. So monthly, this is what we have here in the monthly time frame. On the weekly time frame, you can see also we'll get a continuation here. Perhaps price may come take out this old high here. We never can tell. But since the Swiss National Bank chair, Shigel, had said that that inflation will be coming higher, that kind of counteracts the negative interest rate that market is anticipating for the Swiss economy. So we'll be watching the SNB very closely because we are only interested in selling this pair. And should we have a weak GDP data in the UK tomorrow, that will give us, more weapon to sell this pair. So we are closely monitoring the Great Britain's CHF. On the daily time frame, so far this week, we have had a bullish day on Monday. For the rest of the week, Tuesday, this is Tuesday, Wednesday, Thursday price, it had been weak. So perhaps the GDP data tomorrow will help push it to the downside. For the last pair we are interested in selling for the long time is the Australian dollar against the Canadian dollar. We can see price is basically bearish long term. We had seen series of lower highs and lower lows. Currently market is here. Market is currently at a premium. So depending on data, would know whether a sell has resumed because market had been retracing strongly. Let's scale down to the monthly time frame. You can see price had been moving, lower from this point. It had retraced heavily to premium. Market broke, price broke this low here from this. So peradventure we'll see a sell resume, continuation of sell in this pair. So we are watching both economies closely. That is the Australian economy and the Canadian economy. This is price weekly. Price has swept the liquidity sitting here. Price has swept through the liquidity sitting here. Perhaps we'll see a weekly, bearish candlestick formation. All of this is governed by data anyway. As you can see, let's scale down to the daily time frame. You can see we have had 4 trading days this week. Today's Friday. On Monday, the AUD was strong against the dollar. On Tuesday, likewise. But on Wednesday, we had a hammer here, and this fair value gap here was closed, and price seems to be resuming a sell. However, we don't have data on either side tomorrow, but we are only, as I said earlier, we are only interested in, selling the Australian dollar and buying the card. So that is it, guys. That's all I have for now from our charts. I believe that you guys also have peers that you're interested in trading long term. It helps you learn the character of these pairs and master them, and gives you further understanding on why they do the way they do. So that is Market Pulse Weekly for you guys. That is all we have for you this week. Thanks for your time. Thank you for taking our time to watch the video to the end. You are highly appreciated. Kindly like the video, drop a comment. Perhaps you have a question in regard of whatever is in this video lesson. Please feel free to send us a comment, click the bell notification, give us a like, and turn on the notification button to know when the next video will be released. Thank you. Stay blessed and stay safe.